Hello, and welcome to this video on capital investment appraisal. So, capital investment appraisal is should a business invest in a particular capital investment project, and a capital investment project is to spend enough money now in order to receive benefits in future years from a specific project. Well, I've got a few examples to look at. So, the first example, a business is considering investing in either Project A or Project B. The initial cost and net cash flow have been calculated over 5 years as follows. So, Project A and Project B. So the initial cost at the commencement of the project. So Project A, the initial cost is £20,000, and Project B, the initial cost is £28,000. Now the net cash inflow, that's your outflow subtracted from your inflow, is as follows. So we're told all this in the question, in this particular question. Sometimes we have to work it out ourselves. So year one, we've got 8,000 for Project A and 10,000 for Project B. Year two, 12,000 for Project A, 10,000 for Project B. Year three, 5,000 for Project A and 8,000 for Project B. Year four, Project A is 4,000, Project B is 9,000. And finally, in year five, we've got Project A is 2,000 and Project B is £9,000. Now, at the end of year five, both projects will have a scrap value of £1,000. So if the projects are disposed of, they will each receive £1,000. This amount is included in the year five net cash inflow above. So it's included in those figures, so that we do not need to do anything else with it. It's included in those two figures. Now, only one project can be undertaken. Which project should be chosen? Now, there are two methods we can look at for a capital investment appraisal. The first is the payback period. This is the period of time it takes for the initial cost of capital to be repaid from the net cash inflows. So I'll set out a little table here now. We've got Project A on the left there, and Project B on the right there, and then the year. Now, if you go back to the information in the question, you've got years 1, 2, 3, 4, and 5. Now, year 0, you'll see here, that's the year when we spend the initial outflow. So for Project A, it was £20,000, and Project B was £28,000. So that's where the £20,000 and £28,000 goes. That's money going out, so it's in brackets. Then these figures here come directly from the question. Now, the cumulative cash flow is the current year's cash flow plus the previous year's cash flow. So in this case, for year 0, there was no previous year's cash flow, so it's just a negative £20,000. For the end of year 1, it's a negative £20,000 plus the £8,000, so that's now negative £12,000. The next one is £12,000, take away £12,000, that comes to 0. The next one after that is 0 plus 5,000, which is 5,000. And we work our way down right down to the bottom to get £4,000 there and £2,000 there. Let's change that colour there, because I don't want that colour there. So that's our £5,000. Right now, on Project B, again, it's similar. The first year is a minus £28,000. And it's minus 28,000 plus the 10,000, so that's minus £18,000. The next year, the third year, or the second year, is the minus £18,000 plus the £10,000 again, minus 8,000. And in the third year, we've got £8,000 coming in, so it's the minus £8,000 plus the £8,000 coming in. That gives us 0. The next year will be the 0 plus the £9,000 coming in. And then the final year is going to be the £9,000 plus the £9,000 that's just coming in year 5. Now you'll notice there's a 0 element in both of these projects. Project A, but the 0 is at the end of year 2. And in Project B, the 0 is at the end of year 3. So what that is telling us, for Project A, the payback period is 2 years. And Project B, the payback period with its 0 there, is 3 years. So basically what it means is, we'll get our money back from our initial investment earlier in Project A, so it'll be 2 years. From Project B, it'll be 3 years. Right, a few advantages of payback period. It's easy to calculate. It's easy to understand. There's an emphasis on the earlier cash flows, which should be more accurate than later cash flows. It's ideal for high technology projects, but could easily become out of date. Now, disadvantages of the payback period. All cash flows after the payback period are ignored. Effects of inflation are ignored. Time value of money is ignored. Life of the asset is not considered. And estimates of cash flows may be inaccurate. Now, some of those disadvantages are taken into account in the next method, which is called discounted cash flow. That's also referred to and known as the net present value. It recognizes that money has a time value. So it compares net cash flows at their present values, that's today's value, with the initial cost of the capital investment to give a net present value of the capital project. Now, the discount factor, you're given it in exams. You don't need to worry about where all of these decimal numbers come from. You're given all those in exam. And this question, we're told, is using a rate of return of 10% per annum. So back to project A then. Got our years 0 down to 5, and that's our cash flows we're given in the question. So to work out a discounted cash flow, you take your cash flow, you times by the discount factor. So for year 0, it's the negative 20,000 times £1,000 gets negative 20,000. The next year is the 8,000 times 0.909, which gives us 7272. The next year, year 2, is 12,000 times 0.826, which gives us £9,912. Third year is 5,000 times 0.751. That gives us £3,755. Year 4 is 4,000 times 0.683, which is £2,732. And year 5 is 2,000 times 0.621, which is £1,242. Now, to work out the net present value, we add all of the discounted cash flows together. So basically, the net present value there is £4,913. Well, they're saying the cash flows over the period of 5 years in today's terms would be equivalent to £4,913. Now, project B, again, we've got the years 0 to 5. The cash flows are in the question, and the discount factor, we're told them in the question as well. So go on to work out a discount cash flow again. So year 0, it's your negative 28,000 times 1. The next one, it is 10,000 times 0.909 for year 1, which is 9,090. For year 2, it's 10,000 times 0.826, which is 8,260. Year 3 is 8,000 times 0.751, which is £6,008. And year 4 is 9,000 times 0.683, which is £6,147. And year 5 is 9,000 times 0.621, which is 5,589. So again, if we want the actual net present value now, is a combination of all of those discounted cash flows. So we add them together, we get £7,094. What that is saying then, cash flows over the 5 years in today's terms would be equivalent to £7,094. Now, if you look at the two projects, Project B got a higher net present value than Project A. So therefore, it's recommended then that a business accepts or takes on Project B. So Project B is better as it produces a higher net present value than Project A. Right, a few advantages and disadvantages now. So advantages of discounted cash flow. All cash flows are considered, so all of the years. The time value of money is used. The timing of cash flows are taken into account, and calculations are easy to make. Disadvantages: the cost of capital is difficult to obtain and may vary over the life of the project. So I can now question here, we've taken it to be 10%, and that could vary over the period of time. Users of this information may not understand what net present value means, and estimates of cash flows may be inaccurate. Now I'm going to go back to the payback period. So we go back to our example on the payback period. The payback period here was an exact number of years. So Project A was 2 years, and Project B was 3 years. Now, it doesn't always work out. It's going to be an exact number of years. So that's what we're going to look at now. So, it's an example where the payback period is not an exact number of years. Harvey Limited is investing in new machinery for its factory. The machinery is to cost £650,000. The expected cash flows are shown below and are assumed to accrue evenly during the year. So I'll just check my accrue there. There we go. So year 1, the cash inflow is £400,000. The cash outflow is £200,000. Year 2, cash inflow is £550,000, and the cash outflow is £300,000. And in year 3, the cash inflow is £750,000. The cash outflow is £350,000. So what is the payback period for the machinery to the nearest day? So I've set out a little table here. I've got the years, so I've got 0, which is the money, the year when the money is originally spent at, and our spending here for the machine is £650,000. So that's my cash outflow there. And I've got year 1, year 2, and year 3 are taken directly from the table there. Now if I want the net cash flow, that's going to be the cash inflow minus the cash outflow. So for year 0, it's negative £650,000. That's the amount we actually spent. Year 1 will be the 400,000, take away 200,000. That comes to £200,000. Year 2, we do 550,000, take away 300,000, so we give us £250,000. And year 3 will be £750,000, take away £350,000, which is £400,000. So cumulative cash flow, year 0 is just the money going out in that particular year. Year 1 is £650,000 going out plus the £200,000 coming in. So the cumulative cash flow is now negative £450,000. For year 2, it's a negative £450,000 plus this year's money coming in, the net amount coming in of £250,000. That gives me £200,000, the cumulative cash flow. And for year 3, it's the negative £200,000 plus the net cash flow for that year of £400,000. That gives me £200,000. So you notice here then, there's no value which states nil. It's gone from negative £200,000 all the way up to £200,000. So what we know is the payment period is between those 2 years. So it's between years 2 and 3. So if I just pop that in there, so it's between 2 and 3 years. Now to find the proportion of the second year or the third year, when it actually gets paid, we do a little calculation. So the proportion of the third year, we take the amount required to be paid back in year 3, so that's going to be the £200,000, over the amount received in year 3, which is the £400,000, and times 365 days to give us the number of days it will take to be repaid. So the amount required to be paid back in year 3 is the £200,000. So that's the amount there. So we need another £200,000 to get to 0. Then the amount received in year 3 is £400,000. So it's over £400,000. So if you do the calculation, you've got £200,000, so 200,000 divided by 400,000. You times by 365, and you'll get 182.5 days. Now, the moment you go over a number, like you're going over 2 here, you're going by 0.5, you round it up to the next day. So it's 183 days. So the payback period then for this particular project is going to be 2 years and 183 days. So that's a little explanation on the payback period and the net present value for capital investment appraisal. I hope you enjoyed the video and thank you for watching.